Hey, Rick Soukoulis here. Time to do a little bit of mortgage math. Did you see the roller coaster ride we got yesterday when the Fed increased the rate by 75 basis points? A lot of fun. Hey, but listen, I want to talk about what that means, what it might mean to the market, because a lot of people were very interested in a post I did a couple of weeks ago about the Fed. So here's where we're at, kind of recap. The Fed funds rate and the inflation rate, the Fed tries to keep within 2% of one another. So right now, inflation is at 8%. And I don't know exactly what it is this month because it hasn't come out yet, but it was 8.7. So I'm giving the benefit of the doubt. Maybe the Fed knows more than we do. But anyway, I'm using 8 as a proxy. Okay, probably more than that. Fed just went to 4. So the delta between those two things is 4%, which means the Fed should be pushing rates up. There's a tempo to that, right? Of 2%, because to get it within that range that they're after, to keep inflation and Fed fund rates together, because as interest rates go up, it's going to slow a lot of things in the economy, which will bring back down inflation, and then we can get going on a regular pace again. But that's where they want to be. So I looked at the Treasury market just to kind of have an indication of how long this might last, what we think. And if you look at 10-year T-bills this morning or yesterday, they're at about 4.1%. The long-term 10-year T-bills pegged at around 4%. A lot of people think it's going to stay in that range. However, the short term is moving up even more. A 1-year T-bill, or a 2-year T-bill rather, is at 4.6%. The 1 and the 2, I think, are almost the same. That means that you can invest your money and get 0.5% more if you're only willing to leave it there for 2 years, which tells you that the market believes that interest rates are going to go up in the coming years, but they're going to go down over time. And the 3-year Treasury bill kind of takes that and flushes it out a little bit because it goes down to 4.3, 5 years at 4.19. So the market's kind of telling you we're going to be at this 4% T-bill range for the next 5 years. So what does that mean to rates? Well, if everything normalizes, rates should be somewhere around 6 or 6.25. But right now we're going to overshoot that. So we're trying to tamp down inflation. So I think we got some more news coming on a 60-day schedule, it looks like, from the Fed to increase rates as they try to tamp down inflation. So how does that relate to the mortgage industry? It's all cash out refinances and purchase loans happening right now. A lot of people trying to figure out what to do next, and a lot of people who have figured it out. Now, tonight I'm going to an industry dinner that Garrett McAuley puts on, and Duncan will be speaking. So I can't wait to get his view on a couple of things. One, I want to hear him talk a little bit about the Fed, but also about products. Now, those of you that have been in the industry for a long time, remember Fannie Mae's EA1, EA2, EA3 program, where the credit box was a little bit wider. We were able to bring in other clients that otherwise wouldn't fit. Will they bring back that kind of innovation? If you Google EA1, EA2, 2005 Fannie Mae memo, an old internal memo comes up that's probably been released under Freedom of Information or something, but it shows the logic behind how they did that. Because Fannie Mae is a risk manager. At the end of the day, that's what they do. They manage risk and they guarantee the flow of payments. Take all the other things that they do, that's what they do, and they're very, very good at it. And so is Freddie Mac, right? It's going to be interesting hearing what he has, and I'll report back when I know some more. But product innovation has taken place. I just looked about 7 months ago. I did a video, and I said, look, I think you're going to see 2-1 buy downs come back and other kinds of programs. So what happened? 2-1 buy downs did come back. People are using those to help customers get into houses. They believe that rates may be going down in the future. Customers will be able to refinance out of it. Not a bad call. Yesterday, Plaza and Mutual of Omaha just posted in Ready Price their 1-0 buy down program. So now you can get that rate brought down for a year. Seller can pay the contribution on that. Another big innovation, old product, but hasn't been in the market for a long time. Non-QM is like a popcorn machine, man. It just keeps spitting more and more and more and more out. There's a lot happening in that non-QM space. So for mortgage loan originators, MLOs, guys, our customers on Ready Price, you're looking for a lot of product, it's all coming. Land Home just joined our system, kings of DPA. Just down payment assistance programs all day long. And they are great with niche, products. So you'll see a lot of innovation coming in these 4 categories. I'm going to be anxious to see what happens with Fannie Mae. Do they tighten the credit box? Some people tell me they're tightening it. Do they loosen the credit box? How much time is going to take until we can have a little wider credit for the average, consumer? And then when do the ARM products come back in? What's going to happen with the CFPB? The Supreme Court's looking at the legality of them. So there's a lot of things moving in the mortgage space today. But I guess the news here today is, in the short term, news, take it for what it's worth. In the short term, it looks like we're going to be seeing rates go up for the foreseeable future. I would think all the way through, 23. But now that I've said it, they'll probably go down next week. That's usually what happens to me when I speculate on rates. But that's what the indicators are telling us. I hope this helps somebody out there. Look, if you're a mortgage loan originator looking for a lot of product, go to Ready Price. All of these lenders that I just mentioned and 30 others sponsor the platform. Originators can be on for free. We're glad to talk to you. We're glad to have you as our customers, and we'll look forward to doing our next deal together.